Hey guys, welcome back to my channel. Welcome back to the series, the Turn Your Home Into Two. I know we haven't done this in a while, so excited to get back into it. Today we're going to be talking about 3 ways that you can pull out equity from your home and several ways that you can use that money to build your stability, financial future, pay down your credit cards, all that good stuff. But before we get into it, please be sure to subscribe to the channel. Hit the bell for notification of our upcoming videos. We have a lot of them coming up, including interviews with agents all across the US. We're so excited to bring that back to you. Okay, so let's get into it. 3 ways that you can pull out equity from your home. The first 2 I think are expected, and we're all like, yes, we got this. We know about this, Sasha. You talked about this possibly before. But the third one might kind of surprise you. So, without further ado, number 1, Cashout Refinance. And what is Cashout Refi? It is a way to take your current mortgage, to refinance it, to also include the money that you want to pull out from your equity. Essentially, it's like going back to the time when you purchased the home and getting a bigger loan for the same length of term, or you add additional years, and this is why you should talk to a qualified mortgage lender and see what their programs are. But let me show you how it works. So you have, I'm going to try to stay within the camera frame here. So you have a house value. Let's say if you put up your home on the market today, it's going to cost $980,000. And let's say for easy math, you owe $680,000 on it. So the difference between your value and the loan that you have already is $300,000. Now this $300,000 is your equity, but no bank is going to take you to 100% loan to value kind of loan. So your loan for the house must be some percentage of the total value of the home. And they're going to look at that. Some banks offer 80%, some banks offer even 70, or I've seen on the second option that we're going to talk about, I've seen banks advertise 90 and 95% loan to value ratio. So each bank has their own limits to what they think will create a stable solution for them as a business plan. And it's always a good idea to not fully take out everything that you can. But there are times when you have to, and that's understandable. So you have your house value, you have your mortgage, and instead of getting a secondary mortgage on the home, but you still want to pull out some equity, you can do a refinance and you rework the terms of all of your debt on the house. So it's the first mortgage, and this additional amount is going to become one mortgage altogether. Now, a part of the benefit of this is you may get a lower interest rate by doing this, but it's not as flexible as the second option that we'll talk about. So all that to say, when you do a cash out refi, you're pulling out the money one time. So you can do multiple refis throughout the years, but every time you do a cash out refi, you pull out the equity, you pull out the money, and that's how much you pay the extra interest on. That's how much you pay your monthly payment on. So let's say you pull out an extra $200,000 on the house, and you right now only need to use $50,000 of that amount. Well, you're gonna get all $200,000 all at once into, let's say, your checking or your savings account. But that also means that your payments don't just go towards what you use, they go towards what you took out. So your payment is now going to be from the principal of the original mortgage that you had, original loan, and with this additional amount that you took out, all one bundle. So now you're paying your principal and interest towards all of this amount at once. So the cautionary thing here is don't take too much from more than what you need. So if you only want to do cash out refi to lower your credit card, to do something like that, and you only need $200,000, well, or $20,000, sorry. Consider that if you take out a loan for $100,000, you may have that amount sitting but you better have a plan with that money that's sitting into your account, because you're going to be paying interest on it. It is not as flexible as the second option, but you can get a lower rate. You can do it all in one swoop. And if you need that bigger amount, like let's say down payment for a new home, I'm giving away the little tidbits that we're going to be talking away at the end. So, if you need it as a down payment, then this can be a great solution. And you're going to have one mortgage on this house, so you don't have to worry about multiple payments a month. It can be easier to handle. Number 2, there we go, in the camera frame. Number 2 is HELOC. Now, a HELOC is like your credit card. It's like taking your house, you minus the current loan, and there's going to be less than the actual top value of the house, because every bank, like we talked about, has this percentage that they're willing to take you up to. So just account for that. And then this part right here, you can get as a HELOC. A HELOC, unlike a traditional cash-out refinance, a HELOC is a secondary mortgage on the home, but it is used like a credit card more so than just pulling all the money out at once. A HELOC is very flexible that way. You can get it like, you can have 10 years to pull the money out and 20 years to pay it back. There's very flexible terms in that. So a HELOC is like the bank is saying, okay, we've gone through the process. Here's the maximum loan amount, let's say, of $80,000, and this is your HELOC, home equity line of credit. So you have your HELOC, and then you hold this credit card in your hand, and you're like, okay, so let's say I want to do some remodel. I want to change out the backyard a little, change out the deck, do a little bit of landscaping, but I'm not going to splurge on the house all at once. So in 2 months' time, I'm going to pull out like $20,000 to do the decking, the landscaping, and little things here and there. And that's all I need to take out for now. So even though, thanks so much for giving me the $80,000 that I can work with, I only need $20,000 right now. And they're like, fine, you're in a great spot. So we just want you to start paying on this amount on the $20,000, not on the $80,000 that the maximum that we gave you. So if, let's say, you can pull out $100,000 on your equity in your home using a HELOC, but then you only use $5,000, or let's say you have a ton of credit card debt. Let's say you have other things that you need to pay off, and it's just all kind of like snowballing on you, and then you realize you have a resource. It's not like a secondary income, but it's the equity in your home that you can use to lower your interest payments. Well, then take out a HELOC where it's flexible. So let's say you get approved for that $100,000. So you get approved for $100,000 in your HELOC, and you only need like $25,000 to pay down your credit cards, and you only need another $5,000 to pay off something else. So you end up paying that off, and you only need to use that $30,000. Well, that's all you're responsible for. Then you pay off the $30,000, and you're like, okay, so I paid off that loan. And I think it's a good time to do a little remodel on the home. I'd like to take out another, let's say, $50,000 on the HELOC. Because you've already secured the HELOC and it's like a credit card, as long as you have enough money available in that HELOC, you come back to them and you're like, I think I need $50,000 to do that remodel and other things that I talked about. And they're like, sure, now's a great time. There you go. And you're like, cool, I can use just this amount. And again, pay interest on just the amount I'm taking out. So you take it out. You're doing your remodel thing. You're doing your thing. Great. You can start paying off that HELOC. It's like a credit card where you charge your amount every month and then you pay it off by the end of the month. Except for in a HELOC, you don't need to pay off the whole thing by the end of the month, but you make monthly payments because it is a secondary mortgage on the house, and you have the stability. And even though the APR may be a little more than your conventional cash out refi, it pays off in that you don't have to pay the interest rate on the full amount of your loan. You can only, or you will only, yeah, that's the word. You will only pay the interest rate for the amount you consume, for the amount you actually use at that time. So that's the key part. You may end up paying a little bit higher APR, but you're paying it on a much smaller number. So for you, it may be the best solution, and HELOCs are a great way to pull out equity from your home. Number 3. Okay, this one is a little bit out of the box maybe, but you can use the equity in your home, meaning let's say you have a 2-story house. Let's say it's a split level, which in the Pacific Northwest, we have a lot of good homes that are split level homes. And you pretty much use the top level. You don't need all the rooms. You have the bedrooms upstairs, you have the bathrooms upstairs, you have the kitchen, and you've purchased, at some point in time, you've purchased the whole home. But you don't really use the downstairs. Now, if you think this through just enough so that it will be convenient, you can kind of lock the door even between the 2 floors if you wanted to have that privacy, and use the back door as like an official entrance to the lower level. You can always use your home's space, and this is what I mean by using your home's equity, use your home's potential to create a source of income for yourself. So you can rent it out to college students, you can rent it out to families that just settled in the region, so you can do it as a long-term rental, like 6 or 12 months or even 18-month rental contracts. You can even do it as a short-term rental, like if you have a great backyard and you have things to offer and it kind of has enough sunlight to look great for people who are enjoying the weekend. Let's say you live somewhere that's close enough for people to drive out, and they only need to drive out 20 minutes to be able to take that hike or to drive out to the ski resort, and you're in that perfect location. Well, use your lower level, build a little kitchenette there, have an outdoor fireplace, have nice seating. You know, if it's a short-term rental, you always want to have furniture in there, because how would it make sense without it? You can use your home's potential to create a secondary source of income. Now, do keep in mind that out of all the benefits that are out there, you have to take into account what works best for you and for your schedule. So if a long-term rental works best because you simply don't have time to do the screening and to do the payment methods for short-term rentals, and you don't want to constantly be cycling through cleaning the place downstairs, so take that into consideration and do long-term rental. You could also rent it out as a home office space, or if you have enough land to create a nice standalone office structure, make it a rentable space. Why not? Let's say an artist would use it, or students who are cramped together in one spot and they're a music major and they need to have a dedicated space where they don't feel like they're being pressed down on, you know, where they live, and that may be their getaway. Like, there are so many opportunities if you have the space for it, if you have the structure for it. If you don't have the structure but you have the ability, you can always build the structure. So long-term rental, short-term rental, or even not a traditional office but like an office rental. If you catch my drift, I'm talking about a separate unit or maybe a downstairs unit. I've seen this done in even heavily populated areas because a lot of people don't have the space in their home, but they don't want to drive out 40 minutes in traffic to their office. So they find solutions like that, especially if it's a separate, like a mother-in-law suite kind of thing that's separate from the house. You can easily rent it out. So that is solution number 3 to how you can pull out your equity. So now that we talked about the 3 ways that you can pull out your home's equity, let's talk about the huge list of things you can be doing with that amount. Whether you're pulling out your equity or you're creating a secondary source of income for yourself using your property, you can use it for a lot of things. Number 1, if you or your family member wants to go to college and you feel like this is the right thing for you or your family member, you can pull out the equity in your home to cover tuition. Now, with that, consider the fact that as a student, right now there's a lot of resources online that kind of can guide you through, is this worth it or is this a self-discovery journey? And I think that there's a lot to be said for not using college tuition as a self-discovery journey, but take the time to maybe go through like internships, maybe ask people to be your mentors, maybe ask to shadow different professions and find your concentration. And then once you're really sure of it, and you take the time to kind of assess if this is the right thing for you, then go for it. But don't just automatically assume that college and university should be part of somebody's path just because that's what we typically think. And then people get into a lot of debt, and college tuition debt specifically, and they don't graduate with degrees that they can use, or they drop out in the middle and they don't end up using that degree. So after all that, if you still want to use your cash out refi or your HELOC or your secondary income to fund that tuition, go ahead and use it. It is your decision and your choice. Number 2, credit card loans. You can pull out your cash, your equity from your home to slash that interest rate. On average, let's say credit card interest rate can be from like 16 or 18% all the way up to 30. And lately, what I've been seeing is somewhere around 25 to 28. So let's take 25% as your APR on your credit card. By the way, you should see that APR on your statement, on your bill each month, or you can easily call in, and don't be afraid to call in. It's your finance, and the people there will help you through figuring out your numbers and where you stand. So it's not a scary process to call. So let's say your credit card debt is at 25%. But let's say you can get a HELOC for 6 or 7%. That's slashing your interest rate by almost 20%, by like 18 or 19%. That's huge. If you feel like your credit card debt is snowballing on at you and you feel like it's out of control, and as much as you're paying in, your debt isn't being lowered because you're paying it all towards interest, consider using the resources that you have to either pull out equity or create a secondary source of income to pay that credit card down. If you use your home as a secondary source of income, it will take longer. So there are things that you can do in the meantime, but let's just talk about like pulling out and paying it off. You can transfer your debt. Your debt doesn't go away. It just goes away from the credit card category of 25% interest rate, and it's being moved to your house category, and that can like lower that APR and can really allow you to breathe as you're paying it off. Now here's a situation where it can help, and then a situation where it's not going to help you. It can help you in a situation where you had very little control of the process that led you into the debt. And so now you're trying to responsibly take yourself out, and you are committed to making on-time payments and pay off that debt as soon as possible, but you just need you just need to lower that APR to be able to afford it. You can even double your payments if you needed to with a lower APR and then pay off your debt faster. If you're thinking about 25 versus 7% interest rate. But things that may have led you into having this debt, having this consumer debt that are not going to keep following you. Let's say you move into a home and it's your first home, your starter home, and you realize that the water tank is not as good as you thought it was. And then the roof, a lot of people with COVID and all of the high demand on homes and all of that competition, sometimes people bought homes without inspections. Don't yell at me for it. I'm just telling you that is how it is. Or you have people who purchase a home for a good price and they're like, I can handle the remodel. I'm okay with it. Even if it was on an inspection report or wasn't, I'm good to handle it. So you do a lot of DIY work and you do an amazing job at it and you feel good about the actual amount that you ended up paying for this remodel, but the remodel costs money. And in the short meantime, you had to put that debt somewhere, you had to pay for the materials, and you have it on your credit cards. So this is a good situation to just pay it off because you're not going to keep remodeling, people's homes and use your own credit card to do it. So you're going to take the amount you've already gathered, whatever that word is that I'm trying to say. You're going to take that debt, you're going to put it into, you transfer it to your house using your equity, and then stop remodeling. Like, call it good. Stop getting more into debt. If you're capable of doing that, this is a great solution for you. If you got into your credit card or consumer debt, in whatever shape, form it is, if you got into that consumer debt because you had a medical emergency that you didn't expect and you didn't know that was coming, if you had a family emergency that likewise not that you were stepping out and helping people when they weren't looking for your help, and make sure that you don't get into that debt needlessly. But there are real emergencies where you have no idea how you got yourself into that situation, except for somebody needed surgery, or somebody got really sick really fast, or you were in a car crash and the other person didn't have insurance, and even though your car was covered, your medical bills weren't, something like that. Life happens, things happen. If it wasn't part of your daily routine or monthly routine to get yourself into debt, but if it was a situation where you acquired the debt because of an emergency, and now you're finding a solution, this is a great situation for you. Who is this not good for? And this is like the red flag, alarm bells going off. Do not use your equity to pay for your consumer debt if this is part of normal life. If no one got sick, if nothing really was done to get yourself into this debt, but you are like holding a container of water instead of storing your water, which is your income, you feel like there's a bunch of holes all around and you're holding this container and yet water is spewing out everywhere and you don't understand why. There's just so many different things. It's kind of hazy and foggy and you're not sure of your amount coming in and where it's going out. That's a situation where you should really take maybe even 1 to 3 months, maybe even half a year. Give yourself 6 months, okay? You have your home, right? You have the equity in your home should you need to use it, but take the time to not go into that equity and to really take the time to work with a financial advisor or to get educated on how to get out of debt and to assess what is it that you're doing to get yourself into that debt. Because if you're just using it for consumer debt, for for buying clothes, for overspending on your food, for going out to eat all the time, for entertainment, for travel, for having way too many things for your kids. What ends up happening is you pull out, you do a cash out refi or a HELOC, you maximize on your home's value, you look good because you've paid off your credit cards, right? And then you rack those cards up again because it's part of how you do life. And so your habits come back and you max out those credit cards again. And then you're like, oh my gosh, this is crazy. This is not good. What do I do? And in the meantime, your home's equity went up by a little bit more. So you scramble, you run back and you're like, give me more of that equity. And you look good again because you paid off your credit cards. Never put yourself into that cycle because it is not your credit card company that's at fault. It is not your house equity that's going to save you. The only one that needs to be worked on in that situation is you. Like, this is some tough love, but I hope somebody hears this. When your habits create a perpetual cycle of consumer debt, using your HELOC or using your cash out refi isn't going to save your butt. It's just going to temporarily put a blanket over the situation, and you're not going to acknowledge what you should actually be working on. So having so much debt on your house, and then let's say you lose your job. Let's say your partner loses their job. And on average, they say it takes 6 months to find a new source of income, like a stable source of income for someone. So you're maxed out on your home's equity. You haven't gotten your spending in check. And now you don't have any income coming in. Who's going to save you? Who do you expect to be responsible to save you? What you should be doing is, if you needed to, you can have those credit cards. If you need to, you can have the equity in your home to pull out on. But you know the income that's coming in, you know exactly what you're paying out, and you can handle life simply from your income. You can handle covering everything without touching those credit cards, without touching that home equity line of credit or that cash out refi. And in that point, you are healthy enough, you are responsible enough to be able to use that credit card because you're going to pay it off, or to be able to use that equity because you're going to be responsible with it. So there is a huge difference between who should be using equity and who shouldn't. And let's not get those two categories mixed, because it's like night and day, right? You either are responsible with your money, but things happen, or you don't know what's going on and you're clueless and you need a little help to get you out of those habits, to get you out of that perpetual consumer debt. And help is there. You can get out. You can start with our budgeting series. You can watch a couple of amazing resources online that are available for free. You can read books. You can go to a financial advisor. You can get control of it. You can feel empowered to actually tell your money where to go. You don't need to be in this fog. But don't run to your home equity just because of that. Okay, so let's say you're in a very healthy position. You are responsible with your money. You know how much is coming in. You budget how much is going out. And you are in a great spot. Now you want to add a secondary property to your portfolio. So let's say you do need your house space, all of your house space, or you live in a house where you can't split the floors up. Let's say your garage and kitchen and living room are on the first floor, and then all of your bedrooms are on the second. You could still rent out a room if you needed to, but other than that, you can't really split it up like that. That's okay. You can use your home's equity to use as a down payment for your next home. Now, when you do that, consider this as you're applying for a loan on, let's say, a condo, because that's what I recommend people start with. If you have your primary place, start with a condo as your rental, because it is a little bit easier to manage. There are most likely HOA rules to follow, but you don't have to worry about exterior things that may just be a little too much and a little overwhelming to deal with on your first rental property. So you can use your home's equity to put down as a down payment on your condo or on a townhouse or even a house, whatever it is, on your second property. Keep in mind the fact that when you're applying for a loan on the second property, that bank will see your primary mortgage, and that bank will see your HELOC or Cashout Refi, and they're going to see this amount. So by maximizing on your home's equity, it's the same thing as taking out a bigger loan on your house, creating a bigger payment that you need to pay each month, right? So if you follow those steps, now you're paying more each month on your home because you have a bigger loan on it now. So when you're looking at your second place, when you're looking at your rental property, that bank will want to see that you can afford their loan and that you can afford your primary resident loan. So now you have to take into account, is your income big enough? Again, loan to debt ratio and income to debt ratio. So can you cover this mortgage and that mortgage, and you'll still be fine with those percentages that the banks have to make sure that you should qualify for the loan. If you do, you can certainly pull out that equity to use as a down payment. If it will push you over the edge, have an honest discussion with your loan officer before you do the equity. Have an honest discussion and say, hey, can you run these numbers for me? And this is the conversation I'd recommend you have. Listen, I have a primary residence. I have my home, and I've lived there for a little bit. I have equity saved up in the home that I can pull out to use as a down payment or to remodel this new place. That's one option. But I'd like to see if you guys will even qualify me for this new loan for the secondary property if I pull out the equity. The other solution I can have is maybe not give as much of a down payment. Maybe I can't give 20% down, but is there a program that you have if I can only, like, using just my income, if I can put down like 5% and or 7% on the home right now? Or maybe like I can take out a smaller amount from equity to make sure that I have enough that goes into it. What are my options? Can you do a couple of comparisons for me? And that loan officer, most loan officers are amazing loan officers, and they are so dedicated to educating their clients, to showing you where you can stand financially, to showing you what you can afford, that they will certainly run those numbers. And there's no caveat to doing that, okay? It's all about giving you the options and having you base your solution from actual knowledge and figuring out what is best for you. So you can look at your equity and you can say, great, I can pull out $200,000. But then how will it affect that loan? Like, maybe you should only pull out that $20,000 to just get the down payment done, and that's it. Maybe that program won't be as bad with a smaller down payment, because then your income will cover everything and you will be able to get that secondary place. So if that makes sense, talk to a loan officer, and I can recommend you an amazing loan officer. He and his team are ready to help you, ready to empower you with that knowledge, and they'll be more than happy to run all the numbers that you guys need in the world. If that process seemed very confusing, or if I ran through it too much, please put a comment below, and I can do a separate thing of actually having like a scenario where we draw it out, and maybe I can ask a loan officer to come in on the series and to kind of explain how the numbers would stack up for an average income for an average price of homes. Like, we're gonna just pull out numbers and keep the income one throughout the situation and keep the home values one throughout the scenario and just run those numbers, because this shouldn't be a scary experience for you. It should be part of, like, you're going in to talk to your doctor about your medical health. You're going in to get a will done for yourself and your family, so you talk to an attorney. You go to a loan officer to see where you stand financially and what your options are, and should you or shouldn't you exercise those options. It should be part of the things that we do as healthy adults, okay? So part of the series is just to lift the veil and to stop this from being the scary, scary conversation that we either feel like we'll never get up to that level, or that's way too complicated and I could never call a loan officer and ask, because then they're just gonna keep calling me. Like, there is the right way to go about this, and it's all for you. So there you have it, 3 ways that you can pull out your equity in your home or use your home to create more income, and all the ways that you can use it on. Thanks so much for watching this video. Thanks so much for coming onto the channel in the first place. If you haven't yet already done so, please subscribe to the channel. Hit the like on this video if you found any of it helpful. If you have further questions, or if you want to comment on my tough love thing, comment below please, and send it to people that you know it may help. And as always, so excited that you're here. Can't wait to see you next time.